You need to see what happened to silver in the last 72 hours. You need to see the chart. You need to see the numbers, because what I am about to show you is not speculation. It is not theory. It is documented fact. Silver just smashed through the $90 barrier for the first time in history. It hit $92.15. And the reason it happened has nothing to do with normal market forces. This is about a Federal Reserve criminal investigation. This is about China weaponizing supply chains. This is about COMEX inventories collapsing to decade lows. This is about the entire paper silver control system breaking down in real time. And I have the receipts. I have the data. I have the evidence. And by the time you finish watching this, you are going to understand exactly why Citigroup is now predicting $100 per ounce by March 2026. But before I get into the details, I need you to do something. Please comment below and tell me where you're watching from. What country, what city? Because this information needs to reach every corner of the planet. The mainstream financial media is not covering this story. They are burying it. They are running defense for the banking system. So comment right now. Tell me where you are from, and let us start. On January 11th, 2026, the United States Department of Justice served Federal Reserve Chair Jerome Powell with grand jury subpoenas threatening a criminal indictment. This was not a rumor. This was confirmed by Powell himself in an official statement on the Federal Reserve website. Powell stated that the investigation relates to his June testimony before Congress regarding the $2.5 billion renovation of the Federal Reserve headquarters in Washington. The Department of Justice under the Trump administration claims Powell misled Congress. Powell responded by saying this investigation threatens the independence of the Federal Reserve. He called it an unprecedented attack on the central bank. And within hours of this announcement going public, gold hit an all-time high of $4,600 per ounce. Silver exploded past $90. The dollar weakened, Treasury yields spiked, and the entire financial world went into panic mode. Why? Because when the Federal Reserve loses credibility, when the institution that controls the United States money supply is under criminal investigation, investors run for safety. They run to hard assets. They run to gold. They run to silver. And they do not care what the price is. They just want out of paper currency. They want out of the system. This is safe haven demand on steroids, and silver is catching the full force of it. Now let me give you the exact timeline. On January 13th, silver was trading at $83 per ounce. By January 14th, it hit $90 for the first time ever. By the afternoon of that same day, it peaked at $92.39. That is a $9 move in under 48 hours. That is a 10% gain in 2 days. That does not happen in commodities markets unless something fundamental has broken. And what broke is confidence. Confidence in the Federal Reserve, confidence in central banking, confidence in fiat currency. The market is screaming that paper money is not safe anymore. And when paper money is not safe, physical assets become the only refuge. Silver, gold, real things that cannot be printed, that cannot be inflated away, that cannot be manipulated by central banks. That is what we are witnessing right now. But the Federal Reserve investigation is only part of the story. There is another massive catalyst driving silver prices into the stratosphere. And that catalyst is China. On January 1st, 2026, China implemented strict export licensing requirements for silver. Let me explain what this means. China controls approximately 60 to 70% of global silver refining capacity. They mine roughly 130 million ounces of silver per year, but more importantly, they process and refine silver from all over the world. And now they have put export restrictions in place. If you want to export silver from China, you need a government license. And those licenses are not easy to get. This is economic warfare. This is China weaponizing their control over critical mineral supply chains. The United States classified silver as a critical mineral in 2025. Russia announced they are allocating government funds to buy silver for strategic reserves. And now China has restricted exports. Do you understand what this means? It means the global silver market just became a geopolitical battlefield. It means countries are hoarding silver because they know it is strategically important. It means supply is being locked up by governments. And it means private investors and industrial users are competing for a shrinking pool of available metal. This is not a temporary squeeze. This is a structural shift. And the price is reflecting that reality. Let me show you the supply and demand numbers because they are absolutely shocking. According to the Silver Institute, the global silver market has been in a supply deficit for 5 consecutive years. 5 years in a row where demand exceeded supply. In 2025, the deficit was 117 million ounces. That is one of the largest deficits in modern history. Total annual mine production is around 830 million ounces. Total annual demand is over 1.2 billion ounces. Where is the extra metal coming from? It is coming from above ground stockpiles. It is coming from COMEX inventories. It is coming from London vaults. It is being drained out of the system. and it is not being replaced. Now combine that structural deficit with China export restrictions. Combine it with Russia buying silver for reserves. Combine it with safe haven demand from the Federal Reserve investigation, and you have a perfect storm. You have a market where physical silver is disappearing and the price has nowhere to go but up. Now let me talk about the COMEX, because this is where things get truly insane. COMEX is the commodities exchange in New York where silver futures are traded. It is the primary mechanism for price discovery in the silver market. And right now, COMEX registered silver inventories have collapsed. Registered silver means metal that is available for delivery against futures contracts. As of this week, there are only 58 million ounces of registered silver in COMEX vaults. 58 million ounces. That sounds like a lot until you understand the leverage in the system. Each silver futures contract represents 5,000 ounces. Open interest, which is the total number of active contracts in the market, is currently over 140,000 contracts. That is 700 million ounces of paper silver exposure. But there are only 58 million ounces of physical metal available for delivery. Do the math, that is a 12-to-1 leverage ratio. If just 8% of contract holders demanded physical delivery, the COMEX would run out of silver. 8%. That is all it would take to trigger a delivery default. And what is happening right now? Delivery demand is spiking. More and more traders are standing for delivery instead of rolling their contracts. They want the physical metal. They do not trust the paper anymore, and the inventories are draining. According to a report published on Seeking Alpha on January 13th, there is an unusual trend developing at COMEX that suggests an accelerating silver squeeze. The report highlights that registered inventories have dropped over 70% since 2020. 70%. In just 5 years, the available silver for delivery has been decimated, and this is not because of reduced mining. Global mine supply has been relatively flat. This is because physical demand is overwhelming the system. Industrial users need silver for solar panels, for electronics, for electric vehicles, for 5G infrastructure, and they cannot wait for paper contracts to settle. They need the actual metal. So they are pulling it out of COMEX. They are pulling it out of London. They are pulling it out of every vault they can access. And once it is gone, it is not coming back, because industrial silver is consumed. It is used in manufacturing. It does not get recycled like gold. Once it is embedded in a solar panel or a circuit board, it is gone forever. This is a one-way drain, and the market is starting to realize it. Now let me show you what the banks are saying. On January 13th, Citigroup released a bombshell forecast. They are now predicting silver will hit $100 per ounce by March 2026. $100. That is another 10% gain from current levels. And they are not stopping there. Citigroup says silver could reach $110 per ounce by the second half of 2026. Why? Because they see heightened geopolitical uncertainty. Because they see structural supply deficits. Because they see safe haven demand accelerating. And because they see the paper silver market losing control. Citigroup is one of the largest banks in the world. They have access to proprietary trading data. They have access to client flow. They have access to information that retail investors do not see. And they are telling you right now that silver is going to $100 in the next 60 days. This is not some random analyst on the internet making wild predictions. This is Citigroup, and they are putting their name behind this forecast. But Citigroup is not alone. HSBC, one of the world's largest precious metals analysts, said that investor appetite for silver and gold exchange-traded funds will remain positive during 2026. Bank of America has a silver target of $65. Saxo Bank is calling for silver to hit between $60 and $70 this year. And BNP Paribas analyst Philippe Geisels said silver could reach $100 by the end of 2026. Every major financial institution is bullish on silver, every single one. And the reason is simple. The fundamentals are undeniable. The supply deficit is real, the inventory drain is real, the geopolitical tensions are real, and the safe haven demand is real. This is not hype, this is reality. And if you ignore it, you are going to miss the biggest wealth transfer in modern history. Let me talk about premiums, because this is where the paper price versus physical price disconnect becomes obvious. In India right now, physical silver is trading at an $8 premium over spot price, $8 per ounce. Spot price is around $90. Physical silver in Mumbai is selling for $98. That is a 9% premium. In China, the premium is $5 per ounce. In Singapore, it is $6.50. These are not normal premiums. Normal premiums are 50 cents, maybe $1. Maybe $2 if there is a supply shock. $8 is a market dislocation. $8 means the physical market has completely detached from the paper market. It means the futures price on COMEX is a lie. It means the real price of silver, the price you actually have to pay to get your hands on physical metal, is significantly higher than what the exchange says it is. And when you have that kind of spread, Arbitrage players step in. They buy paper contracts at the futures price and immediately take delivery and sell the metal in the physical market at the premium price. That is risk-free profit. And that is exactly what is happening right now, which is why delivery demand is exploding, which is why COMEX inventories are collapsing, and which is why the system is on the verge of breaking. Now let me show you what happened in the trading pits in the last 72 hours, because this is where you can see the panic in real time. On January 14th, COMEX silver futures settled 7.26% higher at $84.61. 7.26% in one day. That is the kind of move you see in penny stocks, not in commodities. But it gets better. Intraday, silver touched $92.39. That means at some point during the trading session, buyers were so desperate to get exposure to silver that they pushed the price up over $8 in a few hours. That is not normal market behavior. That is a squeeze. That is shorts getting liquidated. That is panic buying. That is the market screaming that there is not enough supply to meet demand. And when supply is constrained and demand is spiking, the price goes vertical. We are watching it happen right now. CME Group, which operates the COMEX exchange, just announced they are launching a new 100-ounce silver futures contract on February 9th, 2026. Why? Because retail demand for silver exposure has exploded. The standard COMEX contract is 5,000 ounces. That is over $450,000 of notional exposure at current prices. Retail investors cannot afford that, so CME is launching a smaller contract to meet demand. This is the exchange admitting that there is massive interest in silver. This is them saying, we need to create more access because people want in. And when an exchange creates new products to capture demand, that tells you the trend is real. That tells you the momentum is real. And that tells you the price has a lot further to go. Let me give you some historical context, because if you understand the past, you understand what is coming. In 1980, silver went from $6 to $50 in 6 months. That is an 800% move. Why did it happen? The Hunt brothers tried to corner the physical market. They bought contracts, they took delivery, they kept accumulating until the exchange changed the rules. The COMEX banned new long positions and forced liquidation-only trading. The Hunts could not buy anymore. They could only sell, and the price collapsed. That was market manipulation by the exchange itself. They rigged the game to protect the shorts. Fast forward to 2011. Silver went from $18 to $49 in 4 months. That is a 270% move. Why? Retail demand exploded. The American Silver Eagle program could not keep up with demand. Premiums spiked. Delivery delays stretched to 6 weeks. And then the CME raised margin requirements 5 times in 2 weeks. 5 times. They made it prohibitively expensive to hold long positions. Speculators were forced to liquidate, and the price collapsed. Same playbook, different decade. Now we are in 2026. Silver just broke $90. COMEX inventories are at decade lows. China has restricted exports. The Federal Reserve Chair is under criminal investigation. Safe haven demand is at record levels. Citigroup is predicting $100 by March. And the physical market is completely disconnected from the paper market. Do you see the setup? Do you see what is coming? This is 1980 and 2011 combined on steroids. Except this time the physical shortage is global. This time the buyers are sovereign nations, not just speculators. This time there is no single entity the exchange can target to break the move. This time the shorts are trapped, and when they try to raise margin requirements, it will not work, because the physical bid is coming from governments and institutions that do not care about margin. They care about metal, they care about reserves, they care about protecting wealth from currency debasement. And when the delivery squeeze triggers, there is no rule change that can fix it. The metal is gone, the vaults are empty, and the price is going to explode. Let me talk about industrial demand, because this is the part that most people do not understand. Silver is not just a monetary metal, it is an industrial metal. Over 50% of annual silver demand comes from industrial applications. Solar panels use silver. Every solar panel has about 20 grams of silver in it. The solar industry alone consumes over 100 million ounces of silver per year. And solar demand is growing at double-digit rates every single year. Electric vehicles use silver. Every electric vehicle has between 25 and 50 grams of silver in its electrical systems. EV production is exploding globally. 5G infrastructure uses silver. Every 5G cell tower, every 5G base station, every 5G device, they all use silver. Electronics use silver. Medical devices use silver. Silver has antimicrobial properties. It is used in wound dressings, in catheters, in medical equipment. The medical industry consumes 35 to 45 million ounces per year. And that demand is consistent. It does not go away in a recession. People still need medical care. This is structural demand. This is not speculative. This is real consumption, and it is growing every single year. Now combine that industrial demand with investment demand. Exchange-traded funds are seeing record inflows. The largest silver ETF, iShares Silver Trust, has seen net inflows every single week for the past 2 months. Investors are piling into silver exposure. Retail buyers are cleaning out coin dealers. The United States Mint reported that American Silver Eagle sales in December 2025 were the highest in over 3 years. Demand for physical silver coins and bars is off the charts. And this is not just in the United States, this is global. India imported over 10,000 metric tons of silver in 2024. That is 321 million ounces. China imported 8,000 metric tons, that is 257 million ounces. Combined, India and China absorbed 70% of global mine supply in 1 year. 70%. Where is that metal coming from? It is coming from Western vaults. It is being drained from COMEX. It is being drained from London, and it is flowing east. This is a permanent shift. Asia is accumulating. The West is being drained, and the paper markets are pretending it is not happening. Now let me address the elephant in the room. What happens if the CME runs out of silver? What happens if delivery demand exceeds available inventory? The legal term is force majeure. That is when an exchange cannot fulfill its contractual obligations, when they do not have the metal to deliver against contracts. When that happens, they have 2 options. Option 1, they source metal from somewhere else. They pay whatever price is necessary to get physical silver delivered to the vaults. That means buying in the spot market. That means bidding up the price. That means a massive short squeeze as the exchange scrambles to cover delivery obligations. Option 2, they declare force majeure and cash settle contracts. That means instead of delivering physical silver, they just give you the cash equivalent based on some settlement price. But here's the problem. If they cash settle, that destroys the credibility of the futures market. It tells the world that COMEX contracts are not backed by real metal. It tells industrial users they cannot rely on the exchange for supply. It tells investors the price is fake. And when credibility is destroyed, the entire system collapses. The paper market becomes irrelevant, and the physical market takes over price discovery. That is the endgame. That is what $100 silver looks like. That is what $200 silver looks like. Because when the paper market dies, there is no suppression mechanism left. The price is whatever a willing buyer will pay for physical metal. And in a supply-constrained market with exploding demand, that price can go anywhere. Let me tell you what you need to do right now. If you are holding physical silver, do nothing. Sit tight. Do not sell into the volatility. Do not get shaken out when they try to dump the price in overnight trading sessions. Every dip is going to get bought. Every paper manipulation attempt is going to fail because the physical demand is too strong, the supply deficit is too severe, and the geopolitical backdrop is too supportive. Just hold your metal and wait for the inevitable. If you do not own silver yet, you need to understand the window is closing. Retail premiums are already spiking. Delivery delays are already extending. Dealers are struggling to source product. Once the mainstream media catches on, once CNBC is forced to cover the COMEX inventory crisis, once the price breaks through $100, the premiums are going to explode. You are going to see $10 premiums, $15 premiums, $20 premiums. At that point, it does not matter what the spot price says. You cannot get metal at spot. You have to pay the premium. So if you are going to accumulate, do it now. Do it while product is still available. Do it before the panic sets in, because once the panic starts, it is too late. And if you are thinking this is all just fear-mongering, let me remind you of something. In March 2020, during the pandemic lockdowns, the silver market went no bid. You could not buy silver at any price for 2 weeks. Dealers were sold out. The United States Mint stopped production. Premiums hit $15 over spot. The spot price was $14. Physical silver was trading at $29. That is a 100% dislocation. And that was during a liquidity crisis when people were selling everything. Imagine what happens when people are buying. Imagine what happens when governments are buying. Imagine what happens when industrial users are panic buying because they cannot source material. That is not a 100% dislocation. That is a 500% dislocation. That is the paper market becoming irrelevant. That is physical price discovery taking over. And when that happens, the price does not go up 10%. It does not go up 50%. It goes up multiples. It reprices to reflect scarcity. And scarcity in silver right now is extreme and getting worse every single day. This is not speculation. This is math. This is supply and demand. This is basic economics. And if you understand it, you understand why silver is going to $100 minimum and why it could go much higher. The algorithm is broken, the paper control system is finished, and the physical market is taking over. Welcome to the silver squeeze of 2026. This is going to be historic.